Okay, let's unpack this. Think about it. How often do you actually reach for physical cash these days?
Hmm. Less and less for a lot of people.
For many of us, yeah, it's probably way down. Now, uh, what if you suddenly couldn't use cash at all? Imagine every single transaction being purely digital.
That idea, well, it can feel like a distant future for some, or maybe for others. It's already becoming a very present reality.
Exactly. And that's the territory we're plunging into today. We've been exploring some really detailed analysis about Europe's undeniable march towards becoming a cashless society.
Right.
This deep dive focuses specifically on that transformation, zeroing in on the European Central Bank's, well, frankly, massive undertaking, the digital euro project.
Yeah, and our mission here is really to cut through the noise. What did this analysis tell us are the core drivers? What are the potential upsides? And maybe most importantly, what are the fundamental questions this shift forces us, forces you to ask about money, about privacy, about who might get left behind?
We're sifting through the details to give you the clearest picture we can of what's happening and, crucially, why it matters.
Because, as the material we reviewed makes abundantly clear, this is way more than just a tech upgrade for payments.
Oh, absolutely.
This is fundamentally reshaping the dynamics between citizens, governments, and the financial system itself. This is where it gets, well, really interesting.
It's a complex picture, definitely, moving at wildly different speeds across the continent, and the implications are profound.
So, okay, at its heart, what does this move to a cashless society actually mean? Based on the analysis, it's an economy where all financial transactions happen through digital means. Physical cash eventually becomes, well, obsolete.
And the force is pushing this forward. The material points to, sure, technological advancement, obviously, but also our changing habits, right? Our increasing preference for tapping a card or scanning a phone.
Right, convenience is a big driver.
And some very deliberate strategic policy decisions being made at the top levels, too.
What's fascinating here, I think, is how quickly it expands beyond just how you pay for coffee. It brings up these core issues. Who controls the currency in a digital age? That's monetary sovereignty.
Okay.
Can everyone still access and use money? Financial inclusion? What happens to your privacy rights when every transaction is recorded?
A huge
And what does this mean for democratic governance itself? It touches everything.
Right. And the digital euro is presented as Europe's big strategic play in response to all this. It's explicitly framed, isn't it, as a way to keep European monetary sovereignty strong.
Exactly. Especially in a world where China has already rolled out its digital yuan, and you've got big tech companies building these powerful payment ecosystems that could potentially sideline traditional currencies altogether.
So looking across Europe right now, one of the most striking points the materials highlighted is this stark divide. You have the Nordic countries, the cashless pioneers,
Way out ahead.
way out ahead, contrasting sharply with nations, particularly in the south and east, where cash is still, deeply embedded.
And the numbers the analysis provides for the Nordics are pretty eye-popping. Norway, almost fully digital. Oh, was it 95% of transactions cashless?
Yeah, leaving only 35% in cash. Stunning. Sweden's right there, 92% digital. Cash use dropped dramatically to 13% from like 40% not that long ago.
And Finland's aiming for complete cashlessness by 2029.
Wow. So how did they get there? The analysis points to a few key ingredients in that Nordic recipe.
Yeah, it seems to be a combination. Strong government support, for one. A population that's highly comfortable with technology, high digital literacy, excellent digital infrastructure, obviously, that's crucial, and a high degree of social trust in institutions. That seems important, too.
Sweden especially is described as a sort of global laboratory. The changes are just pervasive. The analysis mentioned their mobile payment app, Swish. Something like 80% of Swedes use it.
80%, processing nearly 50 million transactions a month.
Incredible. And the examples are everywhere. Banks sometimes won't even accept cash deposits anymore. Stores have card-only signs.
Yeah, the source even mentioned homeless vendors accepting digital payments. It's just everywhere.
Which is a world away from countries like Germany, Austria, Italy, where cash still makes up over 60% of payments.
Right. And the reasons cited for that preference often come down to, well, cultural traditions around using cash, deeply held habits.
And crucially, significant concerns about privacy and the potential for surveillance. That seems to be a big factor in those countries.
Definitely.
Looking at the overall trends across the Eurozone, though, the direction is clear, even if the pace isn't uniform. Cash usage at the point of sale, it's tumbled. From 72% back in 2019 to just 52% in 2024.
That's a huge drop in 5 years.
Huge. Card payments are beaming, growing about 12% a year. Contactless is now the norm for, what, 79% of those?
And get this, over 90 million Europeans are now regularly using mobile payment apps on their phones.
90 million, wow.
But here's a critical strategic vulnerability that really stood out in the analysis. 13 out of the 20 Eurozone countries rely entirely on non-European providers, think Visa and MasterCard, for processing their card payments.
13 out of 20. That's significant.
It is. It effectively gives the U.S. indirect influence over a big chunk of European economic activity. It really adds a major geopolitical layer to this whole shift.
So beyond Visa and MasterCard, the analysis also notes other infrastructure pieces are falling into place. There's the European Digital Identity Wallet.
Right. Mandated by 2026.
Mandated for all member states by 2026.
Right.
And the growth of European-led payment initiatives like EMPSA.
Yeah, that acts like a network connecting the national mobile payment systems. Makes it easier to send money across borders between different apps.
Like Spain's Bizum, Sweden's Swish, or that combined Vipps mobile pay in the Nordics.
Exactly, which handled, 5 billion transactions just last year? Shows the scale these things are reaching.
All these pieces, they create the backdrop for the digital euro project, which the analysis frames squarely as Europe's essential strategic move.
Yeah, safeguarding monetary sovereignty in this rapidly changing landscape. That's the core pitch.
They describe it as aiming to be truly digital cash. The idea is to offer the same level of privacy and universal accessibility as physical cash, but, well, digital.
And importantly, it would be issued and backed directly by the ECB, making it legal tender across the whole Eurozone.
So how would it work? How would you actually use it?
The proposed structure is two-tiered. The ECB issues the currency, but private entities like your bank or maybe other licensed payment providers would handle the distribution and provide the services to you.
Sort of like how banks give you a debit card today.
Pretty much, yeah. You'd likely access your digital euro through your existing banking app or maybe a dedicated ECB app, converting funds from your current account.
Okay. And one specific design point mentioned is a proposed holding limit, maybe around €3,000 per person.
That's the figure floating around, yes. And the reason for that limit is crucial.
Right, it's not meant to be a savings account.
Exactly. It's designed to prevent the digital euro from becoming a place where everyone just parks their savings, which could pull massive amounts of money out of commercial banks' disintermediation.
So it's intended primarily for everyday payments.
Right. There's even talk of a waterfall mechanism where balances above the limit would automatically flow back into your linked bank account, reinforcing that it's meant to complement, not replace, the banking system.
Got it. Now, privacy and security, they're presented as absolute cornerstones of the design.
They have to be, really. The ECB is aiming for what they call the highest possible level of privacy, comparable only to cash, specifically for offline payments.
Offline, how does that work?
The vision is that small transactions, maybe up to a certain limit, could be stored and processed directly between devices or cards, locally, mimicking the anonymity you get with physical cash without needing immediate central logging.
Interesting. But what about online transactions? The majority, presumably?
For online, it's a bit different. They'd use techniques like pseudonymization and encryption. The idea is to protect your identity while still allowing for necessary checks.
Checks for things like anti-money laundering, preventing crime.
Exactly. AML, CTF, the standard stuff. The ECB says they'll only keep very limited data and have independent supervision.
However,
yeah, the analysis is clear-eyed about this. While the intent is privacy-focused and the system must comply with strict rules like GDPR,
right,
the very nature of a digital infrastructure inherently creates the capability for real-time monitoring in a way cash simply never allowed.
So the potential for surveillance, even if legally restricted, is fundamentally higher. That's the concern.
That's the core tension, yes.
Okay, so timeline. The material lays this out. This isn't happening tomorrow.
No, definitely not. The investigation phase wrapped up in 2023. We're currently in the preparation phase, running through 2025.
And that involves a lot of testing.
Yeah, over 70 private sector partners, banks, fintechs, retailers are busy testing the different parts of the system right now, kicking the tires, basically.
The really critical moment comes when? October 2025.
October 2025, that's when the ECB's Governing Council is set to make the final decision. Go or no go on full implementation.
And if they give the green light.
If they do, the earliest the digital euro could realistically be available to you, the public, is apparently 2028. Still a few years away.
And there's a whole legal side, too. A framework that needs approval.
Right. There's a proposed legal framework from the European Commission that still needs approval from the EU Council and Parliament.
And the analysis notes progress there has been slow.
Slow, yeah.
Hmm.
Partly due to political caution and also significant lobbying from the banking industry, which, as we said, faces potential disruption.
Makes sense.
An ECB board member, Pierre Cipollone, is quoted saying they'd really need that legal approval by early 2026 to make a launch 2-3 years later, that 2027-2028 window feasible.
So the next couple of years are absolutely crucial decision-making years. A lot has to fall into place.
Absolutely critical.
Okay, let's step back and look at the human side of this. The social implications. The analysis really emphasizes this.
Yeah, it's not just about tech. It creates real risks of social stratification. The term digital divide crisis even comes up.
And the numbers are stark. Across Europe, millions of people are simply not ready for this. We're talking 2.4% of citizens who can't even afford internet access.
Right. Basic connectivity.
And 13.5 million people in the Eurozone are completely unbanked. No bank account, no digital lifeline.
For these groups, moving towards a cashless society isn't about convenience. It's about potential exclusion from daily life, from the economy.
Vulnerable groups get hit hardest. The analysis points to the elderly. 3% of those over 65 have no digital access at all. They rely entirely on cash.
And in some countries, like Cyprus, Greece, Malta, that number is closer to 10%. That's significant.
Think about homeless individuals, too. They often struggle even to open the bank account required for digital payments.
And the term cash bubbles is used in the analysis.
Cash bubbles.
Yeah, to describe these isolated pockets where cash might still work, but they're becoming increasingly disconnected from mainstream businesses and services, potentially trapping vulnerable people inside them.
Other factors make it worse, like rural communities, often limited digital infrastructure, fewer physical bank branches or ATMs.
Creating what are sometimes called banking deserts. Yeah.
And the COVID-19 pandemic actually accelerated this, didn't it?
Unexpectedly, yes. Many businesses switched to cashless only and often made those policies permanent, further marginalizing cash users. Bank branch closures also contributed to those banking deserts.
Research cited, for example, from the UK found a staggering 8 million adults would genuinely struggle in a cashless world.
8 million.
German research highlights the lack of digital literacy and tech access among significant portions of older and lower-income populations.
The analysis really hammers home this paradox. The promise is digital inclusion, but the reality risks creating significant new forms of systematic exclusion.
Yeah. There are also significant cultural and psychological impacts that the material touches upon. Cash isn't just for buying things.
No, it's a tangible tool. Especially for financial education. That's an interesting point raised.
How so?
Well, the analysis suggests that physically handling cash, seeing the money leave your hand, helps people visualize spending and understand budgeting in a way that just tapping a card doesn't.
Right, it's more concrete.
Exactly. Could be particularly important for younger generations learning how to manage money.
And there's the flip side of digital convenience, the cashless effect.
Ah, yes. Studies suggest people tend to spend more freely, more impulsively, when they're not using physical money.
There's a psychological disconnect, right?
Yeah.
It feels less real.
Precisely. You don't feel the money disappearing from your wallet in the same way.
The analysis also briefly touches on the loss of cultural artifacts. The unique designs on coins and bills, part of a nation's history.
Which could simply disappear over time.
Yeah. And the potential for being constantly trackable in a fully cashless system that could contribute to increased stress and anxiety for individuals, even if they have nothing to hide. Just the knowledge of it.
It's a background hum of potential surveillance.
Okay, shifting gears to the economic transformation. The banking sector itself faces potential seismic shifts.
Big time. The analysis references a calculation by Copenhagen Economics, estimating potential deposit outflows of $739 billion from commercial banks if the digital euro launches.
$700 billion. Even with the holding limit.
Even with that 3,000 holding limit, that's about 10% of household deposits across the Eurozone.
Wow. And smaller banks could be disproportionately affected.
Potentially, yes. Losing maybe 20% of their deposits, seeing a 13% hit to their net interest income, which is a core part of how they make money.
Now, banks currently spend a lot handling physical cash. The analysis puts it at 535% more than digital transactions.
Right, and those costs are ultimately passed on to consumers or businesses.
So going cashless could reduce those costs for banks.
But if the ECB makes the digital euro free to use, as is often discussed, for basic use.
Then it directly competes with the bank's current payment revenues,
Yeah.
which make up around 17% of their income.
Exactly. So it's a double-edged sword for them. The analysis suggests banks will have to adapt, offer more value-added services, get better at data analysis, manage digital assets.
And the ECB is planning liquidity support measures to help banks manage potential deposit shifts.
Yes, and the analysis believes total digital euro holdings up to maybe 1.5 trillion would be manageable for overall financial stability. It's a big number, but potentially manageable.
Okay, what about potential upsides economically? Cross-border payments is one area highlighted.
Yeah, this is seen as a major potential benefit. The digital euro is envisioned to allow instant 247 settlement of payments across different currency zones.
Potentially saving billions currently lost in fees and delays.
Right. And strategically, it's seen as a direct way to challenge the current dominance of the US dollar in international payments and strengthen Europe's monetary sovereignty.
Plus, just making transfers within the Eurozone smoother and cheaper, a common integrated European payment method.
Definitely.
For businesses, the impact varies. Large corporations probably benefit most. Streamlined operations.
Small businesses, though, they face upfront costs to upgrade their systems, estimated between $500 million and maybe $14 billion across the EU.
But could save on cash handling and reconciliation in the long run.
Potentially. However, the analysis points out ongoing costs like payment terminal rentals, transaction fees, tech support. Those can really eat into the margins of small businesses.
Especially those with lower transaction volumes. And businesses in rural areas often struggle with reliable internet connectivity.
Exactly. It's not a universally rosy picture for small business.
Tax authorities, though, they're definitely anticipating a major upside.
Oh, yeah. A reduction in the shadow economy. Every digital transaction leaves a trace. Makes it much harder to hide income or engage in illicit activity.
Better tax compliance could boost government revenues significantly. The analysis points to U.S. tax evasion costing over $100 billion annually as an example of the scale.
Some studies cited even suggest widespread cashless adoption could lead to a modest boost in GDP growth, maybe around 0.17%, through improved efficiency and reduced costs.
Which naturally leads us to the most fundamental questions this raises: politics and governance. The analysis stresses privacy and surveillance are paramount concerns here.
Absolutely central, because, as we said earlier, every single digital transaction creates a permanent, potentially traceable record.
Compared to putting cash in your pocket, which is anonymous, this is a dramatic shift.
And privacy advocates are sounding alarm bells. The potential for unprecedented government surveillance capabilities.
Tracking every purchase, monitoring spending patterns.
And even in extreme scenarios, the ability to restrict access to funds. That gives authorities capabilities they simply never had with physical cash. Groups like European Digital Rights, Privacy International, they explicitly highlight the potential for financial censorship.
Which ties directly into the idea of democratic participation and financial autonomy. Cash offers a degree of freedom, right? No permission needed.
Exactly. You hold it, you spend it. No log, no intermediary approval needed for the transaction itself. A cashless system shifts this power dynamic, makes citizens potentially more dependent on digital infrastructure and institutional approval for basic economic life.
And not surprisingly, this has led to political resistance. Switzerland, for instance, considering constitutional amendments specifically to preserve access to cash.
Sweden, too, despite being a pioneer, has seen significant public debate. That constitute, the cash rebellion movement.
And the analysis uses a really striking example from the material: the Canadian Freedom Convoy in 2022.
Yeah, that was powerful. Authorities, under emergency measures, froze 206 bank accounts linked to protesters and supporters, see $7.8 million.
While a court later ruled that action unreasonable, it serves as a stark illustration of how quickly and easily financial exclusion can happen in a highly digital, centralized financial system.
It shows the potential power inherent in controlling the digital rails of finance.
Returning to monetary sovereignty and geopolitics, it's a point the analysis really reinforces.
Yeah, that reliance on U.S. payment giants like Visa and MasterCard, it gives the U.S. indirect influence.
So the digital euro is seen as building Europe's own independent infrastructure for strategic autonomy, especially when, 66% of card transactions currently go through non-European providers.
Right. The ECB views the digital euro as essential to safeguarding the anchor function of central bank money, that foundational trust from state-backed money, and preventing foreign or potentially unstable, unregulated digital monies from dominating European markets.
Okay, looking beyond Europe, the analysis provides crucial global context. China is way ahead with its digital yuan, the ECNY.
Already operational, yeah. Process trillions of yuan in transactions. But it operates with what they call controllable anonymity, meaning transactions might appear anonymous between users, but they are fully transparent to the authorities. It effectively creates, arguably, the world's largest financial surveillance tool.
A very different model from what Europe says it wants.
Very different stated goals, yes. The U.S., by contrast, is still very much in the exploratory phase for a digital dollar, non-committal, deeply divided politically.
Mainly due to concerns about surveillance and potentially crowding out the private sector.
Those seem to be the main sticking points, yes.
Other early examples, like the Bahamas sand dollar or Nigeria's naira, cited as cautionary tales.
Yeah, they show that simply launching a central bank digital currency doesn't guarantee success. Nigeria's naira has seen very low uptake, struggled with trust issues, implementation challenges.
So even within Europe, individual countries have different approaches beyond the main digital euro plan. Interestingly, Sweden's own independent e-krona project
Concluded remarkably that there wasn't currently sufficient social need for a state-issued digital currency.
That's a pretty significant step back for a cashless pioneer.
It is. Shows the complexities. In the UK, a digital pound would need parliamentary approval, faced intense demands for strong privacy protections, 50,000 consultation responses.
The Netherlands has put in requirements for geographic ATM coverage, ensuring cash access within 5 kilometers. Germany maintains stronger requirements for businesses to accept cash.
Seeing access to physical cash as a fundamental citizen right.
Yeah.
And Eastern European countries, while developing digital capabilities, still face infrastructure challenges, making cash crucial.
And here's a point from the analysis that really underscores the need for balance. Norway, one of the most cashless countries.
Passed a law in October 2024 requiring merchants to accept cash.
Requiring it. Why?
Concerns about system resilience and potential vulnerabilities. Specifically mentioning Russian cyber threats. Even the pioneers recognize that having cash as a backup option is essential for national resilience. Payment diversity matters.
Fascinating. So let's quickly recap the core benefits and challenges that the analysis laid out.
Okay, on the benefit side, potential for significant economic efficiency, cost reduction, faster payments, lower cash handling costs, maybe programmable money possibilities, better monetary policy tools.
Then there's the argument for reduced crime, increased financial transparency, harder to hide income, engage in illicit activities, better tax collection, potentially less crime.
And finally, innovation and competition, stimulating fintech, enabling micropayments, pressuring incumbents, building ecosystem resilience with a European alternative.
But on the challenge side, the analysis warns forcefully about financial exclusion and the digital divide.
Absolutely. Millions potentially left behind. The unbanked, elderly, vulnerable, those cash bubbles in banking deserts.
There's the serious risk of cybersecurity threats and system resilience. The whole digital system is a target. Needs robust offline and backup capabilities.
Right. Think power outages, telecom failures, cyber warfare.
And crucially, the risks around power concentration and democratic governance. Shifting power to central authorities. The potential for surveillance and abuse, that China example.
The loss of the privacy buffer cash provides. Even the risk of digital bank runs, potentially faster and more systemic than traditional ones.
Looking ahead, the analysis presents two broad future scenarios, kind of forks in the road.
Yeah, there's the optimistic vision. Digital efficiency, innovation, genuine financial inclusion achieved through careful design and policy. Seamless cross-border payments, more efficient public services.
But there's also the sobering cautionary picture, a two-tier society. Millions excluded, privacy eroded, vast surveillance capabilities, diminished individual financial autonomy.
And the risk of financial censorship, that Canadian example, again becoming a very real possibility.
Timeline projections vary by country, but overall EU cash usage expected to keep declining significantly, maybe 30–40% by 2030. Though Germany, Italy likely much higher than the Nordics.
Right. And the analysis stresses that the ECB's decision point in October 2025 is perhaps the last best chance to embed crucial citizen protections, strong privacy, mandated inclusion directly into the design before things get locked in.
By 2030, most major global economies will likely have made firm decisions on their own CBDCs. Europe's cautious approach could be an advantage, learning from others.
But it also risks falling behind strategically if it waits too long.
So, based on its findings, the analysis offers recommendations for the path forward. What are the key ones?
Above all, ensuring an inclusive transition is non-negotiable. That means actively working to keep cash as a truly viable option alongside digital.
Implementing privacy by design, not as an afterthought. Making genuine digital inclusion a fundamental requirement.
Exactly. Tools like the digital ID wallet, digital literacy programs, geographic standards for access, better infrastructure, universal design principles, physical alternatives like prepaid cards, all seen as crucial.
And privacy protection needs to be at the core.
Meaning privacy by design in the tech, clear legal frameworks preventing surveillance creep, anonymity for small transactions, robust data protection, independent oversight.
Minimizing data collection in the first place seems key. Transparency, citizen control, opt-outs where feasible.
Absolutely. Encryption, pseudonymization, regular privacy impact assessments, public reporting.
And finally, democratic governance throughout this whole process.
Vital. The analysis calls for robust public participation, clear accountability, independent oversight bodies, parliamentary approval for key steps, meaningful consultations involving civil society.
Preventing mission creep, where the digital euro expands into broader social control, is highlighted too.
And some argue for stronger measures, like those constitutional amendments discussed in Switzerland, to explicitly protect citizen rights in this new landscape. Clear legal frameworks for data access, citizen rights.
So the analysis really brings it back to that core tension. Transformative shift, immense potential benefits, but equally significant risks. Inclusion, privacy, autonomy.
And the decisions being debated and made right now in these next few years are absolutely critical in shaping which path we go down.
So bringing it full circle to the question posed at the end of the analysis, Europe is truly at a crossroads with this. This isn't just tech. It's fundamental choices about the kind of society we're building.
Yeah, the next 2 to 3 years in particular will be decisive.
The analysis strongly concludes that the choices made today will determine whether Europe's move towards a cashless future becomes a positive example of democratic innovation and genuine inclusion.
Or, conversely, a cautionary tale. Technological overreach, where every transaction is tracked and physical cash becomes little more than a memory. A museum piece.
The very nature of economic participation and democratic self-governance hangs in the balance.
Which leaves us with a crucial thought from the material for you to consider. As digital money becomes more and more common in your daily life, are you paying close enough attention to the critical decisions being made right now?
Decisions that could ultimately determine whether your money truly serves you or potentially holds the power to control you. What stands out most to you from everything we've explored today?